Morning.
Good morning. How are
Good
you?
morning. I'm doing great. It's a great day here. A great day here in Southern California. Sunshine. It's a nice day. Yeah.
Good.
Well, good morning and happy Wednesday, everyone. And thank you for tuning in and be with us for another episode today. And as usual, we are here every Wednesday at 10 a.m. Pacific time. Welcome to WellDoctors.us Live. I'm Dr. Andrea Lee, and along with me is Dr. Stephanie Ardrey, your guide through the world of personal finance. So whether you are a seasoned investor or just starting out your financial journey, we empower you with practical tips, and hopefully, with the information, you can make a more informed decision to meet your financial goals.
Oh, today we have a great topic. I'm excited. I can't wait to jump in. We're going to be talking about infinite banking, which is really one of the benefits, I think, of
Right.
insurance policies.
This topic I'm very excited to share with you this topic because it has intrigued a lot of people. This past week, we get quite a few questions regarding infinite banking concept, how it works, how do you become your own bank, how much money is needed to have for infinite banking to work, and is it legitimate, pros and cons. So let's dive in and break it down for you.
Great. Let's go. So, what I understand is typically infinite banking is about using a whole life policy that begins to build some type of value. Is that just any policy, or should we be looking at a particular type of policy? Does a policy have to be structured in a certain way for this concept to work?
Ngay thùng nó về.
Um, you know, uh, the infinite banking concept finance strategy created by Nelson Nash. There is a book that he wrote, Becoming Your Own Banker. So that would be a good book if you wanted to read more about infinite banking. But basically, it's a financial strategies that allow you to become your own bank. So utilize what type of policies. We're going to go into more details. What type of policy fit best for this concept. How it works is generally to open a life cash value life insurance policy, and as the cash values builds up in your account, you can borrow against that and to pay at a low simple interest rate. And the amount that you borrow, the most wonderful thing about this concept is that the amount that you borrow against your policy, um, the remainder, or as if you're not taking out the whole amount, you continue to earn and compounding interest in your account while you borrow that amount out for to fund whatever that you need at the time.
So that's interesting because some people will say, well, that's kind of how a regular bank works, right? I deposit my money in my bank account, and then if I want a loan, I just go and apply for a loan with the bank. What's the difference here?
The difference here is, let's say you have a business and you wanted to fund, you need 50K to fund your business. So now, with traditional banking, you would have to go to the bank and apply for a loan, a business loan, a personal loan. And the process of application is not a simple process. You have to go through credit check, you have to go through, for business loan, there's a lot of requirements to meet. It's a long process to get that loan versus if you have your money cash value in your life insurance policy, you can just borrow against it. It's not an application you simply request. It's a form for you to fill out and request that amount, and that could be done in a week or so. And the money that you have in there, of course, you want to have to structure the policy needs to be structured right in order to take out the amount of money. So let's say if you have about 10,000 in your cash value life insurance, and you taken a vacation and you spend $4,000 on your vacation, and you borrow that from your credit card at a 30% interest rate, which is quite a bit, right? Nowadays, interest can be as high as 30%. So now, instead of paying, your credit card, that interest, you can borrow a portion of your cash value life insurance and pay for that loan and slowly repay back your loan to your insurance policy. You do have to pay a simple interest, but it's not going to be 30%. It's anywhere could be 5 to 8%. So it's making more sense. When you have a cash value life insurance, you have it's like a cash flow, a credit line, almost, that you have access to it.
And it seems like, using the vacation as an example, typically I would say, well, I'm not so much worried about the interest rate because I'm going to deduct it. But if you're on a personal vacation, then you're
Mhm.
not going to have that as really an option. Whereas if you have money that you've put in a tax advantage policy and you're able to pay off your vacation at a lower rate, now I think you're winning and winning, right? It's a double win. Plus, you're keeping the value of the overall death benefit in the event that something happens. So it does seem like a little bit of a better option in terms of how you're making money work for you. It seems like your money's doing two jobs.
Exactly. I mean, you borrow out, you don't have to apply for a loan, and your money is in there, is tax advantage grow, is compounding interest as if you're never taking it out. The earning interest is uninterrupted. You do have a debt benefit, so that will help to protect you at the same time. So there's several benefits for to have a cash value life insurance policy, a permanent life insurance policy that provide you additional protection and the cash flow that you need should you need to fund your business or whatever the reason is. College funding, buying a house, buying a car, anything that you think of that you need to access a fund in your cash value life insurance policy, you can do that without the traditional banking of going to the bank and borrow the money, paying high interest rate, and going through all kind of requirements that you have to meet with bank requirements to get a loan.
That's excellent. And I think that's a lot of times what people forget, even in the example of saying that, for a long time, HELOCs, home equity lines of credit, were very popular to use as a backup way of accessing capital, potentially equity within your home. The problem is you still have to qualify.
Yes, you
So
have to
you find
qualify for
yourself in a
it.
situation that although your home has equity available, if you can't meet the qualifications at the time that you need to access that equity, then you find that you have an asset with equity, but it's illiquid. So there is a benefit of looking at how a policy gives you some liquidity based upon your needs, and especially if you need something pretty quickly. How does this work in the case of a business? We're looking at policies for an individual, but in a business, how would this work for a business owner or owners?
So for business, it's very similar. You funding or you have a life insurance policy, and you have cash accumulation. Let's say you have a cash accumulation of $100,000 in your policy, and that could be a big policy, and you need 50,000 to fund for your business. Now, with that, you can go to the bank and borrow that money, but then unlike the traditional banking system, you have to qualify for that loan. And again, it's a long process. So then you can access 50,000 from your life insurance policy and take that out, fund your business deals. If you have a real estate deal flipping, take that out, and make sure that you have to meet the requirement, and make sure you have enough cash in your account as well in the policy in order to take that out, and also to make sure that the policy is structured in the right way so that when you take it out you don't fall into a situation where it's not enough cash to carry or to keep the policy going. But the simplicity is that you can take out the money with less requirement compared to the bank with the application process that you have to go through, and you can pay it back anytime you want. So, and the interest that you're compounding over time is astronomical. I mean, compounding the interest, compounding the amount that you have in there as if you're never taking out the money. So that's the nice thing about that, right?
Well, one of the things that I think that a lot of times people don't consider is that timing, when one should begin to plan for this type of policy, because really you're paying for both your life policy itself. So there's a portion of the funds that's going to fund the life policy instrument. And then there's a portion beyond that you're able to contribute into the policy to assist with building up this cash value. What I find in some cases is that people underfund their policy. So the cash value is not there
It's not
as they
enough. Yeah.
are desired. It's not enough. And so, I was talking to a colleague a bit ago, and he shared with me that what he's been doing for several, family members is as soon as a new person is born into the family and a social security is issued, is he sets up a whole life policy. And imagine that, because you'd figure, a newborn child has, typically is healthy, you know, has the health and the lowest cost for their portion of the policy. Therefore, there's a great opportunity to add additional cash value that will build. So imagine if your kid is, newborn, and you start funding their policy by the time they're 18 or 21, there are sufficient resources available for a bunch of, those life events, things like if they choose to go to college without being restricted, because I know sometimes
Right.
people use college funds but find that there are specific restrictions around those funds. And if for some reason maybe your child decides that they want to start a business, where would they go to get those resources if they want to start a business rather than going to university? This is a place. Or maybe they decide that they want to invest and go on a trip around the world. Where would they find these resources? Here's an opportunity to find access to those types of resources. And so there's a bunch of different scenarios that one might consider in terms of how this tool could be used and structured.
So it's important, first of all, to have, in order for this to work, you have to max fund your policy. So if you set up, and it has to be set up the right way so that you can maximize your cash accumulation over the years. So let's say, little kid, 1 year old, you set up a policy, and down the road for your purpose is to fund education. So now, you can set up a certain amount at the beginning, and then if you decided to add more on later on into the policy, make sure you let whoever person that helping you to structure that into the policy so that it doesn't become mech. So that's another thing that we want to discuss later on, is once the policy is mech, if you max fund it too much, or when you pour too much money into the insurance policy, it's become endowment contract, so you don't get the tax advantage anymore. So it's important that you discuss that with your agents or your financial advisor. But the most important about this is to max fund it so that you can get the maximum cash accumulation and compounding interest over the years. So down the road, 5, 10, 15 years, 20 years, when they go to college or take out the money for to fund a business or whatever the reason, buying a house, buying a car, they can access that cash value as a policy loan to fund for those needs and goals. And if they don't need, you can put it back in and save that to for later supplemental income for retirement. So there's many ways to do this, and with the policy, it has so many benefits that you can have, such as death benefits, living benefits, such as terminal illness, chronic illness, and critical illness. In events that medical big medical events that happening that you need to access the policy to help you with financial crisis. There are, ways to do that. So there's many ways that you can utilize this kind of policy, and it could be whole life, it could be index life, that to make this policy to work, but to structure it right is very important.
Well, it's so interesting because I was thinking about that as you were speaking, the importance of considering things like chronic conditions. I think so often people avoid addressing, life policies because they focus on its benefit only for death, and no one really wants to talk about and contemplate death. And especially, they feel thinking about their kids, oh my goodness. But sadly, we're seeing an increase in not only chronic conditions for younger and younger people. We're coming across incidents where, sadly, tragically, um, we look at some of these mass murders and things that have happened, on campuses. I'm sure those parents didn't think, that it was possible. I know I sure wouldn't be thinking or worried about the idea of sending my kid to school that suddenly, at school, a mass murder could happen and their demise. But oftentimes, or they could be injured critically, in such
Right.
a way that they require, months and months of hospital care or rehabilitation because they had a tragic injury, or even things as simple as, I remember my son played pee-wee football. And I think it was his high school year. One of the kids that he played football with took a bad tackle, and as a result found himself paralyzed. And so that certainly changed the state of requirements, in terms of future care and therapies. And it seems that, I can say on the business sides, the realities of where people tend to run into financial jeopardy is usually an unanticipated medical or some type of tragic emergency, that not only impacts the family emotionally. So think about it. If you're the breadwinner and you're trying to maintain, your business or your career, but one of your family members has just suffered, a tragedy, a critical condition that now you have to deal with. You could probably benefit from a little bit of time away from your career to be able to support the initial recovery of that member. And oftentimes, it's these situations that force families into financial jeopardy because there really wasn't enough of, you say, an emergency fund, or the funds just run out before you get closer to a finish line in terms of care. Or in a situation, like I found myself where, again, I wasn't expecting to be injured. Thank goodness I had a disability policy that would protect my income, because the injury really required about a 9-month time to fully recover. And if I didn't have the resources to give myself that window, again, it would have compromised my ability to recover. And at the same time, even though there was a liability that was going to be assumed by the party causing the injury, I could not have access to those resources until the end of my treatment period and
Right.
time after that to heal, right? So it was a long lead time that, in the interim, how do you live? How do you survive? How do you, take care of your living requirements as well as your healing requirements?
That is, is absolutely right to have those to think about these kind of things, because especially medical emergency, critical illness, or critical injuries that we don't anticipate and that can happen anytime, untimely death. People don't think about that. I mean, we especially you have family that you have to take care, and you are the main income earner. So who will take care of your family when you no longer here, and getting very, very sick and you no longer can work? Who can replace your income? And another risk is living too long too, right? I mean, we live longer and longer, and until 90s, 100, and you don't have enough fund to last that long. Now, we talk about diversification all the time. When you have a portfolio, a financial portfolio, that should include what? Stocks, bonds, mutual funds, CD savings, 401k, IRA, life insurance. A lot of people don't think they don't need life insurance, but in reality, life insurance is a great strategy to incorporate into your financial portfolio, because that will provide you a lot of protections. Life insurance is for the living, basically. Now, with other living benefits, is it's good to have. And also the retirement income supplemental, especially if you don't have enough in your 401k or your savings. We talk about one, if you get hit with one big medical expense, that could be hundreds of $1,000s. Now you have a house, you have your saving, then you have to deplete your saving first to pay for those medical expenses, because a lot of time health insurance does not provide enough coverage to cover if it's a major operations or a critical illness or terminal illness that you're going through, that you may have to pay out of pocket quite a bit. And so that can deplete your saving, your lifetime saving even, to pay for those expenses. So these are the things that a lot of people don't consider, to have a life insurance policy as a way to protect, not only protection from life insurance policy, but it offers so much more tax advantage growth, access to cash value that you can borrow against for whatever the reason you need to fund your business, to fund for college planning, or to do whatever that you want to do. So it's talk to your financial advisor. I mean, if it's something that you like to incorporate into your financial strategy, they can help you to strategize it in such a way that maximize your earning potential and maximize protection.
Yeah, and I think also it's important to remember that when you're talking about, again, a policy like this where you have to qualify health wise, you also want to make sure that you qualify as early and as soon as possible, because, again, it's rated based on your health. And although you can find policies where you can still be insured if you've had some type of condition, the rating and cost of that policy increases once you've had some type of incident. So if it is that you're predisposed to, certain chronic conditions or hereditary conditions that seem to run in your family, I think it's important to really consider that, knowing your family history, medical history,
Right.
and looking to see how you can protect yourself before those things are issues or concerns, for you, or for, again, if you have children, other family members, while they're at their peak level of wellness, well-being. But also,
Absolutely.
one of the things that you mentioned is that, uh, what your medical coverage will allow and cover these days. What I'm seeing, of course, being in the wellness space, medical tourism, is that a lot of people are looking for alternatives. And sometimes there are alternative treatment methodologies that may not be offered within the practitioners that they have insured with. And so being able to access dollars from a policy so that you can ultimately decide the best course of treatment, that's another benefit of having life policy that also offers you a living benefit in the event that you're faced with a chronic condition and you want to explore, other options. I remember one of my favorite professors, he was a professor and an advisor to me when I was in one of my earlier graduate programs. And along his journey, he experienced a cancer prognosis. And I remember him saying that he was utilizing an alternative treatment. And it seemed really, cutting edge, but thankfully he was able to access the resources to pursue that treatment. And we recently just celebrated, I think it was something like his 50th year,
Wow.
40th or 30th year, sorry, not 50 yet, 30th year of, teaching, contributing at this particular university. And I was so excited that, he was still doing the things that he loved and contributing in such a meaningful way. And I do remember that around the time that he received the cancer prognosis, his children were still relatively young because he had, waited a little bit before he
Right.
began to have children. So it was very important. And I'm sure it was great to have that option, to find another path, that would be more meaningful for you. It's what I'm suggesting to people when they consider our wellness, resorts and locations and other locations, is that there's alternative treatment protocols that you should explore, but certainly you have to have the resources to be able to explore those options.
Right. I mean, it's good to incorporate that, into and take that into consideration when you structure or have a policies, especially starting like you mentioned earlier. The earlier, the younger, the sooner is the better. You don't want to wait until when you need insurance, because when you do need insurance, you cannot buy it. You
You
cannot
know,
get it when you need it. So the younger you start, you have, your health is good, your cost of insurance is low, and your chance of accumulating the cash is more, and the compounding interest over the years is more. Compounding interest on top of interest, right? Is over the years, that could be a huge amount for retirement income or down the road when you need to access the policy. Now, with the pros and cons about this infinite banking concept is that the pros is that when you access the loan, there is no lender approval for this process. You just simply request it with your insurance company. There's a form to fill out, and you can have your money within a week or so. It's a simple interest loan, so it's not compounding like the bank, traditional bank that you go into. There's no credit inquiry for this one. And also with your life insurance policy, you do have so many more options, the living benefits and the death benefits to protect you and your family. um, so what's the cons about this one is, of course, when you have a policy, you have to qualify for that financially and medically, for your health. So the sooner, of course, the earlier you start is better for this one. And also, there are certain requirements that you have to meet for your health to qualify for these kind of insurance policies. So, have to structure, and then also to structure it right too. So it's important that you talk to your financial advisor for these information and compare. You want to compare different policies to make sure that it's maximize your earning potentials, and also how you can structure it to leverage the tax advantage, grow and access that money later on. So there's so many things that you need to consider when you're doing applying the infinite banking concept. It is a great concept that you can access your money, just like a line of credit or to borrow against it. Another thing is, a lot of people ask, so how much you need to have in your infinite banking in order for it to work? So it's not a specific amount that you need to have. However, you need to have enough money in your cash value life insurance to borrow against it. And you don't want to borrow 100%, of course, then, you want to keep the policy going. So you only can go up to a certain amount of percent depending on the carrier that you're with, and make sure that you have enough cash to last you.
And that's important because I hear you saying, depending upon the carriers, that is not all insurance companies offer the same identical products. So
Right.
it's important to be able to speak to your financial team, your financial representatives, and evaluate what are all the options. I remember very early in my real estate purchasing experience, I went to purchase a particular home, and the sellers had set the home up with a set, I guess, financing partner, because they were going to receive a kickback from the financing that they wanted whoever purchased the home to use to buy to buy the property. What I didn't understand was that because I was disqualified to purchase this particular property. So I thought that that meant I was disqualified to purchase any property initially, only to realize later that I was disqualified to purchase that property because they only wanted that particular loan product and I made too much money to qualify for that particular loan
Oh, wow.
product. So it was not that I wasn't qualified to purchase a home. I had to speak to someone else, and turns out I was able to purchase a home almost twice the amount of the home that I was looking at. So it wasn't that I wasn't qualified, I just didn't qualify for that particular program. So oftentimes, I think it's really important to recognize that you may, and I've told people to be aware of this. You know, you apply to a bank. We were using a bank as an example for a business loan, and the bank turns you down. But it might not be because of you, it could be because the bank, each bank has a portfolio of how much money they allocate to a particular sector. If they have already allocated the maximum amount of resources based on the sector that you're in, they may not be able to fund you. You may go to the bank next door and they're able to write a fund, fund you. So it's important to do your homework, is what I'm wanting you to realize,
Absolutely.
and to explore different options, because not all solutions are the same. And because one provider may say no, understand why they're saying no. It may be something else in terms of their limitations as opposed to you and your particular needs. So be sure to, inquire, speak with a number of different professionals until you put together the team that's able to hear your particular needs and understand what your both short and long term objectives are. So it's important to have a team that's willing to listen and hear and work with you to accomplish the desired outcomes. And that's what we are all about. That's why we felt that it was important to share this information, but more importantly, to make ourselves available as options along your journey, to both hear ideals and to be able to learn more about, if it's just the questions to ask, what should I ask my team? And if they can't answer those questions, then it might be
Right.
time to add some more folks to the bench.
Right. So yes, I mean, the most important is you want to have an informed decision. So if you decide infinite banking is right for you, there's a few things that you need to consider. Evaluate your financial goals and needs. So, and also do research and compare different insurance policies to make sure that is best fit in your situation, and consider medical and financial qualification as well. So the best place to start with this, if you're interested, is to speak with your licensed life insurance agent. They can help you structure it the right way and maximize your earning and your meeting your goals. Um, well, we are running out of time. This is such a good topics and exciting topic. A lot of people really have questions about these. So hopefully next time we will have more uh, time to go into details in relating to a topic of infinite banking. But until then, we thank you for tuning in and be with us today. And as usual, we are here every Wednesday at 10 a.m. Pacific time. Please join us weekly. We encourage you to take care of yourself and your loved ones. If you haven't created a plan to protect you and your family, consider doing one. And then if you already have one, consider update and review it to make sure it is the best for you. Thank you so much and have the most wonderful day.
We'll see you next week. All right. Take care.
Take
See you
care.
soon.